Hey everybody, this is Ryan Mallory. Stock market crash. Actually not a crash. We're not crashing anymore. We got the Nasdaq up at all-time highs. We got the S&P 500 down a little more than 1% on the year. Kind of hard to call it a crash when everything in the economy says it's a crash, but the stock market says otherwise. So I guess we're not in a crash anymore. It's just right back up to where we used to be pre-COVID. It doesn't matter if we lose jobs. It doesn't matter if we gain jobs. It's bullish either way. Hey, it's okay if we lose jobs. We're going to stimulate the economy through the Federal Reserve, right? If we gain jobs, everything's better. It's a win-win situation, right? That's what it kind of seems like at this point. Doesn't matter if the jobs report misses, beats expectations, the market just rallies. And I love you guys because you guys have been putting in the comments section how I got this wrong, or I've been a perma bear this whole time and the market's been rallying. I haven't been a perma bear. I keep saying in every video I'm not a perma bear. In fact, I've been long this week. I have win right now, 16%. AMAT, it's like over 7%. I've got Shake Shack. I've been booking gains throughout the week in these positions. I still have a little bit in each trade setup. That doesn't look like a perma bear to me, guys. I told you in the previous video, there's a case for both to the upside and to the downside. You gotta be aware, the market can prove you wrong. There was a time where I was shorting the market, didn't work, okay, you move on. That's part of trading. But you got the guys out there, they think they're cute. They've been trading this market for a couple months now and they got it figured out. There's like, hey, I opened up my Robinhood app, I started an account, I put a few $1,000s in there, I got it all figured out. The market just goes up. Guys, it's crazy because there's literally people quitting their jobs, become day traders because they think this is how the market is. And what's even funnier is when these people try to do the day trading with less than $25,000 and realize that there's a such thing as a pattern day trading rule. I'm not gonna get into it, Google it. But we got the S&P 500, it's up like 5% in the past week, moved up 150 points. We have the Nasdaq hitting all-time highs like I said before. The Nasdaq 100 futures went up 19 out of the last 24 days. Quite the impressive streak there. But you're starting to see a lot of money flow out of the tech stocks and into more of your discretionary and cyclicals. So right now, I get it, the market feels easy, right? It goes up 5% in a week, it goes up 2-3%, 100 points on the S&P 500 day. Feels great, feels like it's easy. It feels like you can do this on a daily basis. What do you need a job for? Quit the thing. You don't need it anymore. But when it's getting that easy, that's when you should be the most concerned about the stock market. That should be when you get most concerned about trading stocks, because there's a lot of red flags out there. And yes, the market's not paying attention to them, but at some point they will. You want to realize that. If things continue to stay bad, it's going to get worse. Okay, Ryan, people are going back and getting their jobs. Okay, that's fine, but there is permanent layoffs. There are going to be jobs that never come back. There's going to be businesses that never come back. There already are. And then you got the Robinhood bros, and the Robinhood bros, they get really mad when I say this stuff. I don't care that you have a Robinhood app, and I don't care that you might be trading large dollars or small dollars. It doesn't bother me either way. But there's a group of you guys, there's a large group of you, in fact, that are the main source of this market rising on low volume. You guys are buying every dip. Good for you, man. You guys are making some money. I hope you know to protect the profits along the way, to book some along the way. Look, you can get into a trade, make your money, and get out. You don't have to hold it for eternity. You make sure that you're protecting your profits along the way, and that's what I'm trying to encourage you guys to do. But I'm also trying to tell you too, hey, don't get into luck and coffee. Look, I get that it went up like 75% in a day. Who cares? Just because the stock goes up 75% in the day doesn't mean that's the trade that you need to be in. Doesn't mean that makes it a good trade setup. Some people got lucky on a stock that literally was shut down for a month and a half, and you're gonna chase this thing after it's up 75% and you're gonna try to chase it for another 20%? Come on, guys. I'm not about being bullish or bearish. I'm about managing the risk, man. If you're not managing the risk, it doesn't matter if you're on the right side of the trade or not. You're going to get destroyed. And the popular cliches out there right now, like, hey, don't fight the Fed, buy the dip. Guys, we've been saying these things forever, okay? It's not anything new. It's not like we've never heard that before, okay? But here's the thing, those cliches are great until they stop working. When the dip buyers all of a sudden realize that nobody's buying the dip, when all of a sudden the stuff that the Fed's doing can't prop up the economy anymore, those cliches are great until it doesn't work. Just like sell in May, go away. What if you would have sold in May and went away? You would have missed out on a big rally, right? That's a cliche. So okay, let's go ahead and jump into the S&P 500. Also gonna go look at some other indicators, and I'm gonna go through a lot of your more familiar stocks that you guys love to trade. I'm talking like DraftKings, Luck and Coffee, American Airlines, Royal Caribbean. I'll go through all these things. I'll give you my thoughts and my analysis on it. It's not about me being a bullish or bearish on it. It's about how you manage the risk. Can you manage the risk on these trades in a way that makes sense and protects you from huge downside? Because stock market's not about trying to make profits. It's about managing the risk. If you manage the risk, the profits will always take care of themselves. But that falls on deaf ears most of the time because most people are just saying, how can I get rich from the stock market? And that's probably what you're focusing on right now, and that's not a good thing. You have to manage the risk, man. And these stocks that I'm going to go through, they are laden with risk. But I'm also going to give you a couple of trade setups that are pretty nice. Maybe they don't go up. Maybe the market peaks this week and the market sells off. Okay, these trade setups probably won't work, but there is a trade setup there and I'm going to go over those as well. First up, check out the S&P 500. We'll use SPY ETF to show this most clearly. Huge gap up. Okay, it was off of the unemployment number being a lot better than expected. Huge gap higher, but what does it do? It goes way outside of the Bollinger Bands. What are Bollinger Bands? There's basically 2 standard deviations of the 20-day moving average. We are way beyond 2 standard deviations of the 20-day moving average right now. In fact, we're gapping outside of that. And what happens? It tends to see a little bit of a pullback. Doesn't mean that it can't continue the trend higher going forward. However, you're getting into dangerous territory where you're chasing a market to the upside that's not going to provide you with the risk reward that you want. You have to be cognizant of that. If you're not, you're going to set yourself up for a potential rug pull in a trade that has a horrible risk reward setup to begin with. Now, let's look at the rising trend line off of those March 23rd lows. You can see they're holding up pretty well so far. It's following the trend. However, even though we're still seeing some explosive moves higher like what we saw on Friday, if we pull back here and pull back to the trend line, that's a little bit of a concern because it's showing that the higher highs are not as strong as the higher lows in this whole trend line. So you're creating more of a triangle that creates a bearish wedge. Again, now we've seen some of these bearish wedges in the past couple months and they've not played out. That doesn't mean that future ones can't play out. You just have to be cognizant of it, okay? When you start seeing it, you have to say to yourself, okay, the potential is there for a break to the downside. You have to be aware of that. But if the S&P 500 pulls back to this rising trend line, it could offer a good time to start loading up onto some positions that you might have missed earlier. Now, what about the Nasdaq Composite? Well, it just made new all-time highs on Friday. Amazing. Blows my mind. I would never have thought that on March 23rd that we would have been saying, hey, in a couple months, you'll be right back at all-time highs. That's crazy. It really is. However, you have to follow price, and price right now still is pushing higher. It's probably one of the better looking indices out there versus the S&P 500, which is trading above that upper Bollinger Band, and the Russell Index, which is doing the same thing as well. Nasdaq has been a little bit more cautious in recent days. You've even seen some of the money rotating out, going into the other sectors, minus healthcare. But going back to the Nasdaq in 1998, we actually had like a 25-30% pullback that took place over about 4 months. And then it just got bought up. We blow past the all-time highs on the Nasdaq, and it like more than doubles. In fact, it went up some crazy like 150, 160% after it made new all-time highs following that major dip. It wasn't until we made those new all-time highs at about 150% clip higher that we actually saw an 87% pullback in the Nasdaq Composite. So maybe that's what we're dealing with here. If you want to look at it from a non-Nasdaq standpoint, you still had a big dip in the S&P 500 in 1998, but then after it went back all the way up to all-time highs, it pushed about another 30% higher before it ultimately pulled back. Now, the pullback in the S&P 500 was nothing compared to the pullback that we saw in the Nasdaq. But still, it saw about a 50% haircut nonetheless. So let's go ahead and jump into some of the more popular charts of late, including the first one being Luckin Coffee, which was shut down for about a month and a half due to there being some fraudulent charges being levied against the company. I haven't been keeping up with the news. All I know is that if you're jumping into this stock at this point in time, you're looking for a world of hurt. Again, it's gonna fall on deaf ears for a lot of you guys. Trading is not about profits. Trading is about managing risk. You manage the risk, the profits will always take care of themselves. Believe it. Embrace that, okay? Because when you manage the risk appropriately, you never have to worry about the profits. They come. It's not about trying to pick these magical stock picks, okay? That's what a lot of people say is like, I got the greatest stock picks ever. That's not what it's about. What it's about is trying to get into trades that offer a good risk reward setup. If you don't do that, it doesn't matter what kind of stock pick you have. You're gonna get hammered. Over the long term, you won't make money. But yes, Luckin Coffee, LK, it got outside the upper Bollinger Band, pulled back immediately, what, about 17 or 18% or so, hits the 50-day moving average, can't really go anywhere beyond that. Lots of volume poured in, that's a lot of retail investors pouring in. This is not a stock that you want to be in, guys, move on. I don't care if it shows up at $16 next week. It's a stupid trade to make. You can't control the risk. But Ryan, you could have gone in at $5.50 and gone all the way up to $16. That's a triple return. Who cares? Again, it's about how you manage the risk, because for every stock that you're going after that you're going to think that's going to be a double or triple bagger, there's about 15 or 20 of them that don't do that and instead cost you a lot of money. How about DraftKings? Meteoric rise over the last couple months here. Insane. Actually though, what's funny about it, even though it's gone from like $11, $12 a share all the way up to $39, $40 a share, its price action looks a little bit more sane of late. It's bull flagging here towards the all-time highs. If it can break out of that bull flag, let's say at like $41 or so, or $42, it has a shot to go up maybe as high as $48 or $50 here. Good, decent risk reward, comparatively speaking, especially when you look at Luckin Coffee. That thing's horrible. Another one that people are chasing after is Hertz Global. Why would you get into this thing? They literally just filed bankruptcy. Oh, but Ryan, You can get so many shares for $3 a share. Don't you want that? No, I don't. I don't want to trade a stock that just went bankrupt. You have huge headline risk on these things. And yeah, I get it. I sound like a Debbie Downer here. I sound like a Karen probably. Who cares? Again, it's about managing the risk. If you're not managing the risk, it doesn't matter what you do in the stock market. It doesn't matter what kind of magic or voodoo stock picks that you have. These things aren't going to do anything for you, because for every one that you get right, you're going to have 15 or 20 of them that go wrong on you. And right now, this is a very forgiving stock market, but it won't always be that way. When it gets the easiest, that's when you should be the most concerned. And right now, it's pretty stinking easy. Another stock that you guys have been jumping on me for, American Airlines, because I did a video, like 23, 24 days ago about the airline stocks. And AAL, I said, hey, look, I don't like the risk reward into it, okay? I still don't like it. And I said, hey, this thing may still go up to $20 or $30 a share, but it may also drop another 20 or 25%. And guess what? It still pulled back after I talked about it, and then it shot higher. And during that pullback, if you had gotten in and experienced that pullback, you were probably looking at a 15, 20% pullback before it finally shot higher. Would you have been able to withstand that 15, 20% pullback before you panicked out of the trade and got out altogether? Possible. Maybe you didn't. Maybe you don't believe in stop losses, and yeah, the market would reward you for that behavior right now. But guess what? If you would have bought AAL at the open yesterday because you're chasing, you're down 15% on that trade right now, because all it did is fade the rest of the day. And going forward, you have some serious resistance going all the way back to September of last year at the $25 level. Again, it could break through it. Market can do whatever it wants. It doesn't care what you think or what I think, but you have to look at these things as potential obstacles going forward. So if you're in AAL, sure as heck hope that you're booking a little bit of profit at least, moving that stop loss up and being cognizant of the resistance that lies at $25. RCL, look at this thing, way outside the upper Bollinger Band. This isn't a time to go chasing. Look at all the gaps on this chart. They're all over the place. If you're in the trade, you need to be at least raising your stop loss to the week's lows or even yesterday's lows. Use a moving average. Use the 10-day moving average as your stop loss. But again, there's still a lot of overnight risk that are associated with these stocks. RCL, AAL, DAL, Boeing, BA. Lots of headline risk that you have to be aware of that can turn on your trade in a heartbeat. BA, Boeing, this one might be the one that you want to not touch at all. You've got this like shooting star candle, massive gap higher. If we gap below on Monday, you have a bearish island reversal way outside the upper Bollinger Band, all by itself. If you're in it, you got into it. I know a lot of Robinhood people got into it. Good, but manage the risk. Manage it. Raise the stop loss. Take a little bit off the table here, guys, because at this point, if you're chasing this stock higher, you're an absolute moron. You don't want to be jumping into this stock at this point. There's huge gaps left to fill, huge headline risk. Look for trade setups that are going to give you a good risk reward setup. I talked about DKNG, way up there, okay? Thing's been on a huge rally, right? However, there was actually a decent risk reward setup going forward if this thing decides to break out of its bull flag. But with Boeing, you don't have that. Now, what about Beyond Meat? This is a popular one. I actually like this chart. You have a rising channel off of the March lows. It's held it. It's really well intact here. Look at that. It's holding it. Maybe it doesn't hold it into Monday. Maybe we get a sell-off. Maybe Beyond Meat breaks through it. But at least you have a good risk reward setup. This thing drops below, let's say, 131. You can even go a little bit wider and say, let's say if this thing drops below 116, might be a time to get out of the trade. It'll be putting in a lower low. I don't want to hold through that and get out. But the potential for this thing is that it's held some major support in recent days. And if it does break out, you could be seeing prices as high as $160, $170 a share. I like this trade setup. You can manage the risk. Boeing you can't, RCL you can't, AAL you cannot do that right now with. How about Ford? Robinhood bros, they're loving the Ford stock right now. It's a cheap stock. They feel like they can accumulate a lot of shares, and it's up 11, 12%. That's great. Again, headline risk. You can wake up, this thing's down 15% the next day. It's possible. The market's not going to go up forever. And like Boeing, why would you get in at this point? Why would you not be trimming some of your profits? It's gone from 550 over the past week all the way up to 734. That's a good time to start booking some profits, okay? You're up like 30-something% at this point. Take some profits off the table, manage the risk, raise the stop loss some. If I'm in this stock right now, I probably have my stop loss below, no lower than the 5-day moving average. It closes below the 5-day moving average, I'm out. If I'm really wanting to be a tightwad about this sucker, I'm putting my stop loss below Friday's lows. Good example of profit taking is GE. The thing opens up almost at $8.50 a share on Friday. It pulls back the rest of the day. What did it give up, like 7-8%? Intraday, yeah, it still finished up 1.8% on the day. It was positive, but it gave up like over 75% of its profits. This is what you got to be careful of in the days ahead with the stocks like LK, with Boeing, with Ford, with RCL and AAL. It's probably going to happen. And if it doesn't, good. at least you had your stop loss there to prevent it from happening to you. And if it keeps going up, then you're good. You're good. And I think GE is probably going to pull back further. It's still outside the upper Bollinger Band, even though it gave up 75% of its profits on Friday. It's way overextended. I'll give you a couple more charts here that I actually like from a risk-reward standpoint. AMD, Advanced Micro Devices. I like the consolidation pattern here. If it breaks out of the consolidation and gets up to around $55.50 or $56 a share, it probably becomes a buy. Even more so if it can breach the 57 mark, because then it's breaking the previous highs. I like the support at the 50-day moving average. It seems like it really wants to hold that 50-day moving average, so watch that. That could be your stop loss, and see if it can't move up to maybe $60, $62 a share. Finally, NextEra Energy. Nobody talks about the stock, pays a good dividend. It's a great company, well managed, and everybody needs electricity, right? Look at this support at the 248 area on NEE. Really solid. It's consolidated a little bit in recent days. It's probably going back up to 280, 285 as long as this market holds up. But again, you can manage the risk. It drops below 248, maybe you get out. Maybe if you want a little bit of a wider stop, you say, okay, if it fills this gap and keeps going, then I want to get out. So maybe you put your stop loss at 240. So I've thrown a lot of trades out there, maybe been a little bit critical of you guys. I have an opinion and you have an opinion. I hope you do well. I hope that if I've upset you, that your trades still do great. I'm not here to demoralize you. I'm here to help you stay in the game, because there's a lot of new traders that are coming into the market right now. And all I want you to do is be able to stay. I think it's good that retail traders are taking more of an active role in the stock market and doing it for themselves. That's what I preach. But I don't want you to do it recklessly. And there's a lot of recklessness out there, especially when you see in what are the top stocks that are being traded on Robinhood right now and some of these other companies. LK should not be up there. HTZ should not be up there. And that's what I'm trying to do. I'm trying to help you here look for good risk-reward setups. It doesn't have to be a stock that makes you all excited and warm and fuzzy inside. It can be a boring stock like NEE, because in the end, profits are profits. And the only way to get those profits is by managing the risk. And if you don't manage the risk, all this is for naught. Profits won't stay with you long term. If you like this video, I'd encourage you to like and subscribe. I put about 1 to 2 videos together every week. I took a little bit of a break this week, but on the whole, I'm trying to do about 2 videos a week. So like and subscribe, you'll get notified when I make a new video. And if you have any questions, feel free to put them in the comments. I'll try to get to many of the comments as I possibly can. I mean, there's always a bunch of them out there, but I do try to answer the large majority of them. Even if you don't like what I say, tell me. Okay? You might not like my response. I don't have to agree with you back, but I'll enjoy the dialogue nonetheless. Thank you and God bless.